Good evening, everybody. All right, tonight we've got the pleasure of having Gordon Scott back with us. Gordon has been kind of associated with us now for the last few years, and the reason for that is through the years I've discovered that no matter how you teach somebody something, it either clicks or it doesn't click, and this was always uh, very strongly illustrated to me when I was in high school. I think I was taking calculus, and I almost flunked it. And obviously wanting to go on to a bigger, better college career, I took it in summer school with a different teacher. And that teacher showed ways of doing calculus where uh, it just was very plain uh, to see what how to do it. So it pointed out to me very very clearly that some people can teach something, and if somebody gets it, and somebody else can teach it, and that somebody that wasn't getting it gets it uh, very clearly. So Gordon is a expert coach. He has actually gotten his training for investing as a uh, right from a one of the uh, market makers right on the Nasdaq. So Gordon is got some very good techniques on how to teach people how to invest, probably a lot more clear than what I do. So Gordon, welcome back to the Candlestick Forum. We're anxious to see your information tonight.
Thanks very much, Steve. It's an honor to be here and to present. I know the coaches have enjoyed working with many of your students in the past and look forward to working with many more. Tonight we want to talk a little bit about crisis investing. If you have heard headlines that get you nervous over the past few months and watched as the market has responded with a volatile move at times, then you probably wonder, gosh, I know there's some opportunity here. What do I do about it? How do I benefit from this? If only I could recognize when is the moment to be calm. And jump in, right? Yeah. Well, that's a little bit of what I hope to be able to share with you tonight is sort of how to think about things that will allow you to invest during a crisis and even trade during a crisis, and especially right after the crisis, because that is where the biggest opportunity is right after it's done. Now, we never know what's going to happen exactly in the markets, but the best predictor of what's going to happen in the markets is having some way of gauging how the majority of people in the markets right now think. And based on what they think, you can get some idea of what's likely to happen next. That's what we want to try to help you with. So here are some tactical principles to understand when approaching the market in the midst of a crisis. It is important, first of all, to understand that investors naturally fear what they don't know. And that's true of anybody. But in the markets, it manifests itself that when people are afraid, they are pulling their money out of their investments, and the prices of investments are going down rather rapidly. And then what the next principle to understand is that investors will naturally overestimate. So, back in 2008, when it became apparent that the mortgage-backed securities and the lending practices of large investment banks, not to mention individual regional banks, were all based on assumptions that were a little bit too optimistic. When it became clear that there were bigger problems than the banks knew about, then investors began to fear because, well, the natural conclusion was, gosh, we don't know how risky these loans are. we got our money in a place where we could lose it, or at least lose more of it than we thought. So they started pulling their money out faster and faster and faster, and prices dropped. Well, comparatively, right? Well, that's the dynamic. That's kind of how it works. But not all the time do you get the situation where investors panic because investors feel like they do know what's going on. But even if they really do know what's going on, or they just think they do, that difference is immaterial. If they think they know what's going on, they behave as if they do, and then that means price is that once an unknown situation arises to make prices fall, then you want to know, when does it end? When will the madness end, right? So you want to know, how can I tell when investors feel like they know enough? And that's the big question. Because as soon as investors do know or believe they know enough about what's going on, then they calm down. They stop panicking and selling. And what investors believe is ultimately the most useful gauge of future actions. So it's really interesting. We're going to talk about today's action right now, today, the way the market's closed today, because that's a real big question. Are we in the midst of a big panic and a big fearful sell-off? And if so, how would we respond to it? Okay, well, let's just assume for a second that we are, all right? I'll give you some information that might make you question that later, but for now, let's just assume that we're in a big panic. So don't you want to know when that panic is over? Well, the first principle, tactical principle, is investors naturally fear what they don't know. So yesterday we had kind of a big down day, and today we had even a bigger down day. So that means that the fear is increasing. The sense of discontinuity about what people know and what they think they need to know has grown, and so they're not sure, and they are beginning to get more worried, not less, right? So where are we in these principles? Are we fearing? Are we overestimating? Or are we beginning to calm down? Well, the answer is not we're beginning to calm down, because we've seen price action increase to the downside. So at a minimum, we are either naturally overestimating or just beginning to fear what we don't know. So that's kind of how you read this particular market action. Now, I want to tell you that whether people are afraid can best be understood by reading the volatility index that the Chicago Board of Options Exchange puts out. This is otherwise known as the VIX. The VIX is the fear gauge. So the VIX is just a complex mathematical formula built on option transaction volume. You can think of it this way, that it measures the amount of protection investors believe they need, right? So, if you have a house on a hillside in a dry region of California, do you feel like you need fire insurance? Well, my house has been here 20 years, has never burned down before. Nobody in the neighborhood has ever experienced a fire. I don't know that I need fire insurance so much. But then one day, a town 10 miles away gets a fire in it, and a house or two burns down there. Now you begin to worry, maybe I should buy some fire insurance. If you call up your insurance agent that day and say, I need to buy some fire insurance, what you're going to hear is, oh, yeah, rates have gone up. Yeah, we had 10 people call just yesterday, and so the insurance company decided that they needed to cover a little bit more of the possible problem expenses, so rates have gone up, right? And that's kind of how options work. They work that way in real time. You know, people buy, price goes higher. And so that's why the VIX is a useful indicator, because the VIX is telling us the sort of ongoing price of protecting yourself against falling prices in the stock market. So you can think of the VIX then as saying, hey, there's a lot of people worried out there and they all want to buy insurance. And it's useful to know that the VIX formula can also be applied to any liquid instrument that has options and futures, you know, like China index or gold index and so forth. There's more and more VIXs on various currencies and commodities and non-U.S. markets occurring all the time. It's very useful. So how do you read the VIX? Well, VIX movement can tell you what investors believe in summary. So this is the big thing. This is really a cool thing, because you see, you can't quickly get on the phone and do a survey of the top 100 hedge fund managers. Say, what are you thinking? Are you afraid of what's going on in the market? Are you worried that you're going to have to just start liquidating positions right now? I mean, even if you could get them on the phone, they're probably not going to tell you. Or if they're going to tell you, it's probably what they want you to believe and not what they actually believe, right? You know? But the VIX doesn't lie. That is to say, it just tracks what people actually do. And people don't tend to buy insurance just to fake out the other guy. At least not enough of them do it all at once. The majority of what gets done is what people actually believe in the markets. And so the VIX is probably about as reliable a bellwether as anything out there, because it kind of aggregates large investors and small investors alike and what they're thinking. If they're buying more options, they're worried, right? So a change in VIX price movement signals a change in the overall average belief of the investor in the market. The VIX peaks, you know, the pointy parts of where they, you know, where price runs up and runs down, that can tell you when fear is beginning to decline. If you have lower peaks, less fear. The VIX also tells you when to expect, the trend of the VIX tells you when to expect that the crisis is over, okay? All right, so those are the steps of how to read the VIX. Well, let's give you a little practice at that. Let's actually do some of that. So here's a slide from a chart from, you know, just the most textbook example of a big market drawdown. I mentioned this earlier, 2008 and coming into 2009, right? Huge bear market, biggest in our lifetime, likely to be the biggest. We'll probably not see another big sell-off like that again. If we do, that, you know, that would be some serious trouble. But very good chance that we won't see that again in the near future. At least not in this decade, I would guess. But meanwhile, you've got a drop of, you know, almost 50% from top to bottom, going through 2008 into first part of 2009. And look at how the charts compare. What you're looking at here, the red line is the VIX, and these prices down here, these are the S&P 500. Okay, so the S&P 500 got to a low point, but not its lowest point, while the VIX reached its highest point, and this occurred somewhere around late October, early November, right in here. And then notice that prices went a little bit lower. And when they did, see, the VIX is supposed to be kind of a mirror of the stock market, you know, an inverse. Market goes down, VIX goes up, right? More people afraid, the more prices sell off. When it doesn't do exactly that, when it doesn't look exactly like a mirror, that's useful information. That's what we care about. And notice here we've got this lower peak that went with a lower price dip, a lower low. So when the price goes lower, the VIX should go higher. But in this case, it didn't. It did make a peak, but that's a lower peak than before. So what does that tell you? See, that is fear is beginning to decrease. Right? The fear is beginning to abate. It doesn't mean the market's done. It just means it's beginning. When is the ultimate sell-off? That's when you start looking for a trend. Lower highs, lower lows. So we've got lower highs. Here's a lower low. Then we get another lower high. Now this is really interesting because at this point in time, March, look how low the price got. This was the lowest point in actual prices, lower than previous November. But the VIX isn't anywhere near where it was. It is so significantly lower. See that? That's the big, when you see this pattern, this is opportunity. And then right here, right at this moment in time, it's the beginning of April, the VIX makes a low, makes a measure below the previous low. From that point on, right there, that's where you can feel comfortable calling it and saying, okay, people believe they know enough. Now, in reality, we had a lot more to learn because there was still a lot of volatility to come, but it was an upward trend from there. And of course, the VIX made a downward trend. Okay, see how that works? All right, now let's step forward in time, a little more recently, just last year. I'm going to look at a more subtle kind of way that you can pick up what the VIX is telling you. So here are the prices of the S&P 500. This time, the red line is the price. It's a line, and the VIX is this choppy actual price action. So I'm showing it to you both ways. You can get a feel. Now, what we notice and care about here, see, again, it's price makes a low, VIX makes a high. It's opposite, right? It's a little Rorschach kind of pattern when you put them together. So here come these highs, and there's the low, okay? Notice the price comes up and makes a new high right in here. But the VIX does not make a new low. This is a big warning sign. That's a big danger sign right there. When that sort of thing happens, when you get new highs, and the VIX, see here we got new highs, and here, but each time the VIX was creeping lower and lower. Now this time it stopped creeping lower. That's a big warning sign. You're supposed to say, hey, I've got to watch out. I got to back off the amount of stocks, exposure I have in stocks. If I have 5 positions, I probably want to cut back to 3. If I've got long stop losses, I probably want to tighten them up. If I have all of my money invested, I probably want to dial back to 50% of my money invested. Let the other 50 sit in cash. Things like that. Those are the kinds of decisions you make when you see this. Hey, look, you can always put them back on if this pattern is going to change. But more often than not, when you see this price is going higher and the VIX getting higher, it's not right around the corner, but it is coming soon. 2 or 3 months at the most. Sometimes it's just a matter of weeks. In this case here, it was about a month, 1 month. And then all of a sudden, prices really started to fall, and they fell fast. And VIX shot way up. Now, that was the crisis, this big run up in the VIX. And the prices dropped really strongly right about the same time. But notice that as soon as they started coming back up, this time frame is October of last year, October 15th. As soon as they started coming back up, what did the VIX do? The VIX didn't act like it was trending higher. See, when it acts like it trends higher, it makes higher lows and higher highs and keeps going higher. Here it came all the way back and got below this previous high. That's the big news. It dipped way back. And when it had, prices had not returned back up to their old highs. So that told you, wait a minute, we dipped down here and then went up and made new highs. Here we made a lower, and then we just got back up to this level. We coming all the way back down here like this, shouldn't we be making on our way to making new highs? But we haven't gotten there yet. So that was a tell that that's what was going to happen next, and that's exactly what did happen. There was a huge run up really quick. Okay, I got my drawing tool a little messed up there, but that's the next move was this very high and strong move, and you could recognize by October 20th or so that was time to jump in. And so that's kind of, another subtle but big example of how you can okay, so can't see the cursor. I'm drawing lines on the chart, but you're not seeing the drawings. Can you guys give me some feedback on whether or not you can see the blue drawings that I'm making when I'm... Yeah, okay, they're seeing it. Oh, lines, not the cursor. Oh, I gotcha. Okay, I gotcha. All right, let me use the highlighter. Here we are. So, so yeah, these candlesticks, these are the VIX, right? And so VIX, when it comes all the way back down like this, and the prices, see the red line right in there, prices aren't all the way back up, that was the signal for opportunity. That was the kind of main thing I wanted you to see on this chart. All right, now a little more recently here. This is just this most recent move, August. This is very subtle. So what I've been talking to you about is kind of about, months or, several weeks and a month or two at a time investing kind of moves. Now here's a trading technique that you're going to want to keep an eye on. So first I'll draw it. See, so we had this huge move down, right? And this rapid rise on the VIX. So these are both candlesticks. The S&P 500 is the gray and white, and the red and green is the VIX, okay? So on this particular chart, we're seeing that we had this rapid rise, fall, and yeah, so I just got a question here. Is it possible to separate VIX from the price? Of course you can. I want you to look at it, though, at the same way, because, look, especially right here. Look close at what I'm about to show you. I'm gonna remove the blue line. Rapid rise up. Let me go to my pointer here. Rapid rise up while the price makes a rapid fall. Okay. Sometimes you get a really subtle difference, and this occurred right here on this day. So prices dipped hard and then jumped back up, then started going down again. There was a moment during the day, towards the close of the day, where this thing, this bar here was very low, and that is, these are daily charts. These are daily charts. And on this day, the S&P 500 had dropped really hard, whereas the VIX was just this sort of doji or spinning top type shape. I mean, that is a huge incongruity. Usually you like the shapes of the charts on the VIX and on the prices to be somewhat comparably similar. But in this case, they were very different, very, very different. When you see that, that's a big opportunity. Now, you look at these opportunities and play it as though the VIX is right. It may not always be, but 7 out of 10 times it will be. Sometimes more over a given period of time, but the VIX is usually more right than the price. And so in this case here, you see, if the VIX were corresponding to the price, we should have had this big green bar where the VIX rising while prices were falling. That didn't happen. The VIX prices fell, but VIX didn't go hardly anywhere. So just think about how you interpret that. VIX is a measure of how much insurance do people feel they need to buy. Prices are falling down, but people are saying, I don't need to buy that much insurance. What does that tell you? That tells you they think they know enough. They are about to calm down. Prices are about to stabilize and rise. And that is what happened here shortly after September. Turned out there was still some volatility left, but generally speaking, we went up from there. And so that's those are 3 different examples of differences between the VIX and the S&P 500. And so that's how you kind of gauge what stage are we in this crisis, whatever crisis we happen to be in. So where are we today? Well, all right. Well, right now we've got kind of mixed signals. And my opinion is that it's mostly bullish, despite the fact that we have this big downward move today. Let me explain to you why. So we have very clear overhead resistance right here, and we have a lot of candle signals that are where near the resistance, showing bearish bias. So overhead resistance is the idea that there's a lot of people who want to sell at a certain price, and anytime price gets up there, there's a great, take profits, sell, 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 sell. I don't want to sell down low. The price is going to go lower than that. I'm going to sit back and wait. But if it comes up here, then I'm going to sell. The thing about overhead resistance is once you get through all the people who want to sell, assuming that there are enough buyers that kind of want to buy anyway, then once you punch through overhead resistance, you usually get a rapid rise up above it. Now, I don't know if we're going to get that, but my guess is that we need to keep an eye out for it. Despite the big down move today, let me show you why. We really don't have a lot of conviction in the volume signals. We don't have it either way. You know, rising volume, rising prices. A lot of people feel like, hey, we got to have rising volume in order for prices to sustain. But that's not actually true. In fact, it's more likely and more common that prices, volume falls as prices rise. In part, it's always that way mathematically. Think about it. If I buy, 1,000 shares at $100 per share, it's $100,000. I've spent $100,000 buying those shares. But if the price of those shares goes up to $200 and I buy only 500 shares, I've still spent the same amount of money, $100,000, right? So I've put the same amount of money into the market, but I have a smaller number of shares. So you see, mathematically, as prices go higher, share volumes decrease. That's a little bit of the dynamic that sort of throws off the thinking. But when you see share volumes coming down in a rapid fashion, you usually see share volumes rising. And before that happens, notice here, see this? See how we have this generally rising format back in the summer? Back in the summer, we had the peaks of the volume were on the rise while prices were falling. That tells you people are sort of growing in their concern, growing in their worry. But look at what we got right now. We got this price that came down, and we're about to hit a peak. And what is the volume pattern doing? It's doing the opposite. It's generally decreasing. So even to the downside, we don't have a lot of conviction in the move. And then, how about volatility? This is historic volatility, not implied volatility, not VIX and options. This is just how much are the candlesticks moving up and down. And the answer is they're getting less and less and less. That's the average true range line there, and that's getting lower and lower and lower. That tends to mean that people are less and less fearful about what's going on. And then the last chart I want to show you here is a comparison of not only the daily VIX, which is the blue line right here, but it's also the short-term VIX, VIX 1 month out, that's this red line right there, and then a medium-term VIX, VIX 2 lines out, that's the gold line there. So here's a quick way to read these lines. Right now, this is what people feel like they need for insurance. Okay, and then I should point out that today, this jumped up to about right here. I wonder if I could draw that on. So this was yesterday's chart that I had to capture before. This thing's gone to about there, and this thing has gone to about there. So they had significant jumps. Okay, they did have significant jumps, no doubt. However, are they serious fearful jumps? That's the big question we have to ask ourselves. Now, it's true that we got a little bit of a higher low on the VIX than there was before. But if you notice, if I go back, the prices are slightly lower. So that's just a mirror action of the prices. That's all that's going on there. Meanwhile, how about 1 month and 2 month out? Do people feel like they need to buy a lot more insurance? And the answer is not much more than they have. We're still kind of in this range, this sort of low-end range for all of the VIX indicators. I mean, back in August, we were way up off the charts, way up high when we hit the peak. And this is the lower peak since then, and lower peak still. So we're still trending lower with the VIX. That's kind of surprising. Now, we'll see what happens over the next little while here, but my guess is that at some point soon, you're going to see the VIX make a peak. If it makes a lower peak than where it has been recently and starts turning around and going down, prices start turning going up, that's probably a buying point because it means people had a little bit of fear, but they got over it. And they're looking to be more optimistic. So with all that in mind, then let's recognize that 2016 may hold big opportunity. It's true the stock market drama is not likely not done, and the China currency impact may have, the Chinese yuan is now part of the reserve currencies of the world. That hasn't had a lot of impact yet, but it might slowly gain impact over time. U.S. interest rates may rise and European interest rates may fall. At least that's what it looks today. I kind of be surprised if that happened. But if it did happen, that could create increased volatility in the markets. Sharp drops, which at least so far as the VIX is telling us right now, even for the next couple of months, are likely just to be short. It's not likely to throw people off. Longer term, more secure investors are going to look at that as an opportunity. They're going to jump in and buy, and they're going to kind of prop the markets up. So it's important to recognize that in crisis, money must go somewhere. And where is it? Where is the opportunity? Well, what we do is we keep an eye on where the winners are. Check out these ETFs. For our bonds on the way up when prices rocket down, TLT and IEF, those are the bond ETF funds. Or how about gold, silver, steel or aluminum, other metals, right? Check out those. Today is a good day to check out all of these and see what went up, what really kind of benefited, right? For my observation, I would say it seems to me that high quality blue chip stocks are of interest to investors right now. Yeah, they all went down today. But go and look at the ones that are considered higher quality. I think you'll see that they went down less than the market averages. There's a good chance that when they start coming back up, they'll go up higher. Now, the reason this makes sense that high quality blue chip stocks should be interesting right now, I mean, just think of, maybe something like CSCO, right? A company that's it's not going anywhere. You can argue about whether or not it has growth prospects, but it's not going to go bankrupt. And meanwhile, just a little bit of growth could mean a lot of movement in the price of the stock. So I think what might be worth watching for is signals on these high quality blue chip stocks, because that's the first place people go when they start to get afraid. When they're not really seriously afraid, they're just like, well, I don't know, I don't want to, I just want to make sure I'm investing in something that's not going to go away. That's why the IWM, the Russell 2000, is on its way down, but the other indexes aren't following it quite so far, because people are clinging to the higher quality, bigger companies, which are found in the NASDAQ and the Dow, by example. Okay, So CSCO is one potential trade idea. That chart was a little old on CSCO. But here's the thing. Now, just because you know, like let's say that everything I told you was perfectly accurate. Market's going to go down a little more. It's going to turn around and go back up. And you say, well, that's it. Gordon knows what he's talking about. I'm going to back up the truck, buy everything, right? Well, no, that's not a very good idea. Turns out even if you know the future, it's not just, where are we going, up or down? It's not just now and some point in the future. It's everywhere in between. You got to know how much volatility, and we just have such a hard time predicting all of that. So what you have to do instead is have a game plan, sort of prepare. What kind of a ride am I going to have to put myself through? I believe it's going to go up, but if I'm right, I'm 70% chance I'm right, let's say. How much am I going to commit to that? Where am I going to know that, okay, this is one of those 30% times I'm wrong? And how much am I willing to lose when I get to that point, right? I got to think all that stuff through. And that's having a plan. It's a simple thing, a simple idea. But it's something that most people just sort of jump right past, get a little too excited, jump right past. You work with a coach, that's what we do. We try to help you make sure that you have somebody to talk to where you're training wheels, and you have that plan. You get yourself in the habit of planning and preparing with every trade you make. Most of the successful traders we work with, they tell us the difference between success and failure is having a solid plan to follow. Because individuals are prone to make lousy traders when they follow emotions, right? The plan reduces that emotional impact. So in effect, you make your money when you prepare, because then if it's a loss, you keep it minimized. If it's a gain, it's maximized. It's not the trading. It's the preparation is that where you find the value. So that's a key point. Now, I hope that this has been useful for you, but I'm going to take the opportunity to turn the time over right now to JJ Gilmore. And JJ, when you're ready.
Wonderful introduction, Mr. Scott. Thank you all for being on this call with us tonight. Before I get started, I'd like to highlight a few things about the individual you just heard from. Because I'm not sure you guys really know how great it is to have Mr. Scott on tonight. Now, Gordon and I have worked closely together for 3 years. And for those of you who do not know, Mr. Scott has been an active investor for nearly 20 years and has coached individuals for more than a decade. He learned the art of day trading from a personal coach, a formal NASDAQ market maker, who taught him an insider's perspective. For experience, he went on to become a licensed broker, a proprietary day trader, and full-time trader in securities, futures, and forex. He's coached over 1,000 individual students with account sizes ranging from 4 to 8 figures. So again, thank you, Mr. Scott, for that wonderful presentation, for all that you do for these organizations, and for all the students that have helped and are currently helping. Okay, again, back to me. This is JJ Gilmore, and I am the program director for Stephen Bigelow's one-on-one coaching department. And you just heard from one of our coaches, Mr. Gordon Scott. And I've been asked to just take a few moments here to briefly talk about the opportunity of working one-on-one with one of our mentors in the coaching program. Now, we have a total of 6 coaches whose resumes in trading and coaching in the markets run parallel to Mr. Scott's. We've had this team of coaches for a number of years, and all of them have agreed to partner on a one-on-one basis to mentor and teach students of the market how to be more profitable in a faster, safer, and smarter way than typically doing it on your own. Really, to help you get to where you wish to be the same way they were able to get to where they want to be after working with a coach or mentor in one capacity or another. So what I would like to do, and I've been asked to come on because we have some openings that have become available, I've been asked to briefly explain this opportunity of working one-on-one with our coaches, I just like to go over 6 commitments that we make to every student who becomes a part of our coaching program. Now, for those of you listening who are interested, once I've gone over these 6 commitments, I'll go ahead and explain the next steps at that point. So here are the commitments that we make to every student. The first commitment is to clearly identify your goals and objectives. The first thing your coach is going to do is quickly assess where you are now versus where you want to be. You would be amazed at how many investors work with from all around the world who do not have a clear goal or objective in mind other than just to make money in the markets. Your coach cannot lead you until they understand what it is you want to accomplish. Now, once we understand your goals and objectives, then you will be ready for a customized plan to be created for you. Now, we will understand your financial reality now versus what you want it to be. In essence, we will see the world through your eyes and gradually expand your vision to a much larger picture than you can see right now so that you see the potential we see when we look and you look at the market. So the first commitment is to identify the goals and objectives. The second commitment becomes the development and implementation of a strategic trading plan. Now, this plan is here to serve as a blueprint or roadmap for you. It will ensure that you reach your financial goals and objectives in the time frame that you tell us, if not faster. Now, as most of you already know, there are a lot of ways to trade. There are a lot of ways to make money in the markets, but what your coach will do is work with you in developing a plan or a system specific to you and your situation. Everyone is different, so as your coach understands the specifics of your situation, he is going to identify the best strategies and techniques and what they are. Now, in developing this plan, the secret to sustained success is to master 3 to 4 key or core strategies. The reason I say that is there are a lot of strategies out there that work, but there's no strategy that works all of the time. You need enough strategies so that regardless of what the markets are doing, you have ways to make money. At the same time, you do not want too many strategies or too much information. That just becomes too much noise or clutter as you go about your system. You want enough strategies to be diverse in the market. Now, mastering these strategies with your coach will happen fairly quickly. This will allow you to reach your financial goals in the fastest time frame possible. Also, bear in mind, there's going to be a high level of accountability involved in coaching. Your coach will hold you accountable to this plan, so if you're going off track, he will kindly but firmly get you back on track and keep you focused. Now, one thing I will make clear, this is not a get-rich-quick scheme. Coaching is not designed to be easy but to stretch you. We are going to challenge every rule you operate by, and in doing so, you will become more aware of opportunities in the markets that you simply wouldn't have seen otherwise. The best part is that you're no longer on your own. You will have a mentor or team of mentors guiding you safely through every step of the way so that you do not make the mistakes you might have made had you been doing this by yourself. The third commitment we make is expert enough to coach others. And we're not talking about you becoming a coach for us, but rather your own level of proficiency will be such that you could literally be coaching someone to success the same way that we would have done with you. Now, whether that's a family member or friend, we believe one of the best measurements of what someone has learned is their ability to share that knowledge with others. The fourth commitment, positive results, making money. Okay, we know that your interest is in doing and not just learning about doing. As so many of us spend so much of our lives in a state of getting ready just to get ready and not really focused on the important part, and that is the execution, the doing, or simply put, taking action. So the fourth commitment is simply to teach you what the most successful traders are doing, and then to actually do it with you. We take the approach of real trading equals real profits with real money. We're not here to make you or anyone else an expert paper trader or an expert demo trader. We are here to ensure that you are making money in the markets consistently. Now, consistency is the key. It makes no sense to make 5% one month and lose it all the next month. And again, as you create a strategic plan and follow those rules, you will start to see the types of gains on a consistent basis that will get you closer to your financial goals, which is obviously what you had in mind to begin with. The fifth commitment, customization of the entire learning process to you. So during this powerful learning experience, your coach will customize every lesson to your level. So for those of you listening who are beginners, we'll move at a pace more compatible to beginners. For those of you who are more intermediate traders, we will move at an intermediate pace. And for those of you who are more at a mastery level, which means you're doing this full time usually, we will customize the coaching program to that level. As you can probably tell by now, this is not a cookie cutter approach where one size fits all, and we understand that. What that means is areas that you already understand or have shown proficiency in, your coach is not going to spend a lot of time on those areas. Likewise, as your coach is introducing new concepts and new ideas, he's not going to move on from something unless he is certain that you understand it and are able to implement it on your own. Finally, the sixth commitment, which is cementing the correct habits. Cementing as in concrete, okay? Your coach will instill or cement the necessary habits for you to become the investor you're saying you want to be. Now, part of cementing the proper habits is fixing any bad habits you might have incurred over the years. You see, habits are the key to consistent success in the markets, and we know that. That's why it is important to make sure that you have a plan or system in place and that you really learn to follow that system. So those are the 6 commitments that we make to every student who becomes a part of the coaching program. I went through that fairly quickly, and I do apologize for the sound, but I hope that you guys can really take from what I just said and imagine yourself working with a coach. For those of you who are interested in getting more information and having a discussion about the coaching program and how it can be customized to you, and for those of you who are serious about making this your best year in trading, we invite you to explore further and find out whether or not this program would be a good fit for the both of us. Now, you might have noticed a poll that should have popped up on your screen. That poll is going to have 3 different options. The first option, yes, I am interested in one-on-one coaching. Please contact me. So those of you who are interested in getting more information, go ahead and select that first option. Option 2, yes, I am interested, but I need more information first. Perhaps you are more on the fence and you want a couple more of your questions answered. Go ahead and select that option. Option 3, thanks, but not interested at this time. Now, I'm just going to pause here as you make your selection. And I want you guys to think about where you are right now versus where you want to be. Quick story. I met a gentleman not too long ago who was a CEO of a very large corporation. I had an opportunity to talk with him. He said the very first day of his trading career, he made $80,000. I said, congratulations. And he said, oh, thank you. I said, you know, sir, what would be impressive is if you could do that consistently. Do you know how to make that consistently? He said, well, no, but you know, the markets is like business. I've built many businesses. I know how to do this. And I gave him an opportunity, really, to get into the coaching program, which he declined. So we parted as friends. I decided to follow up with him 3 months later, and the funny thing is he actually called me back 2 months after our conversation. I immediately recognized him. And asked him how things were going. And he simply just said, JJ, I've lost all my money. I said, so you lost $80,000. He says, well, more than that. I lost the $80,000, but then I lost another $70,000 trying to make back the $80,000 that I lost. I said, wow, do you think if you had a coach, that coach looking over your shoulder, working with you, would have allowed you to lose any of that money? He said, absolutely not. We got him started, and things are going great for him. Now, these are just stories I want to help you understand. What are you doing right now to change your financial situation moving into 2016 to propel you to where you want to be? Okay? So now that you've selected the option on the poll, one thing I'd like to mention at this time is as you're selecting those options and finishing up, keep in mind that this is not a program designed as a hobby or for those who are just sort of dabbling in the markets. This program is very robust. It is very involved, and it is targeted for those who are really serious about their trading, who are looking at doing this as a supplement or mainstream of income. Again, it's for those of you who are serious about making this your best year in trading. Now, for those of you who selected the first or second option, one of my associates will be contacting you in the next 24 hours. and will be scheduling an appointment to speak with either myself or someone I work with to go into more depth and details regarding your situation and identify whether or not there is a fit between what it is that you need versus what it is we offer. I look forward to getting in contact with those of you who are interested in getting more information. I hope that you enjoy the rest of this presentation, and with that being said, I will hand the call back over to Stephen.
Some discontent here. Got to remember, people have different abilities and different perspectives on how to teach other people how to learn. So that doesn't necessarily mean that the way I teach something is the best way. There's other people that have very good techniques for getting ideas or getting concepts through to people. So anyways, take a look at what Gordon has to offer. We're not, I mean, we didn't bring him here just so that you could listen to him. He's got beneficial stuff for everybody. So anyways, with that, Gordon, thank you. And everybody, we'll see you in the chat rooms tomorrow.